It's March 2026 and oil continues to be the most important asset that's moving the stock market. Oil futures have risen 58% over the last month, putting negative pressure on almost all sectors across the economy. And while the S&P 500 is only down 3% year to date, we have already seen a lot of damage, particularly in technology, financials, and software. And while software stocks have bounced a little bit, we see that a lot of big companies are currently in a bear market, including some of the biggest public banks. And guys, the weakness in financials is not a good sign at all. I mean, look at JP Morgan in a 12% correction. Visa, same thing. Blackstone down 31% this year. And I don't believe this is only because of the concerns around private equity. I mean, there's a lot of chatter about how private equity is too invested in private software companies and that they have to do write offs. That's not it. In addition to the ongoing oil shock, we have seen some weakness in the economy. While inflation met expectations last month, and it is getting closer to the 2% target of the Federal Reserve, this does not seem to be helping with unemployment. Unemployment rate continues to trend higher, as we just had a horrible non-farm payrolls report in February, which missed the 59,000 gain expectation with a loss of 92,000 jobs. Another yellow flag was the latest GDP report, which came out at 0.7% annual growth, well below the 1.4% estimate, with consumer spending slowing more than anticipated. Now let's go back to oil for a second because this is what's going to move the markets for the foreseeable future. There's news that President Donald Trump says he's not ready to reach a deal with Iran to end the war. And he's even questioning if the new supreme leader is even alive as he's not been seen in public. He's also now urging allies to help the US secure the Strait of Hormuz so we can lower crude oil prices. On other news, unfortunately, 6 service members lost their lives on Thursday after a KC-135 refueling aircraft crashed in Iraq, which reportedly was not due to friendly fire or enemy attacks. And while strikes continue in the Middle East, the situation doesn't seem to be de-escalating anytime soon. And to be specific, the problem there is that 20% of global daily energy throughput passes through the Strait of Hormuz, or is expected to pass through the Strait of Hormuz. Now, with that said, I want to look at a few charts to see where things could be going. Starting off with the SPY, we can see that the index is approaching the 200-day moving average. So there's two options here. Either we bounce off the 200-day or the situation continues to escalate and we break through the 200-day to the downside, with a potential support at 614 in the S&P. Now, I do want to emphasize how different sectors are performing this year. As we can see here, financials, technology, and healthcare are drastically underperforming industrials, materials, and energy. But we can also observe that although oil prices have been rocketing higher, the gain in the energy index has really not matched the movement in oil. So you could say that it's not having as much of a positive impact on oil stocks that had already run a lot this year, while at the same time it's starting to have a very negative impact on materials and industrials. So that's another thing to watch. So as a conclusion, I think it's reasonable to believe that there is more potential downside considering everything that's going on. And so it makes sense to be more cautious than usual if you have a short-term horizon. But yeah, thank you for watching. That's all I had today. I'll see you next time.